Now, though, it looks like maybe it's the pandemic. They've taught the whole industry a major lesson. According to RBN, my favorite source of fossil fuel analysis, the big producers still haven't gone back to their profligate ways. Of the 38 companies they follow, capital spending budgets are actually down 3% versus last year, with oil much higher. They're spending less than 60% of what they spent when oil broke out above 70 in 2018. Yeah, as long as they don't flood the market with new supply, and Saudi Arabia does the same thing, something they're currently doing, they're holding back because they're so busy paying big dividends with Aramco, then oil prices can go higher. In that case, you know what? Holy cow, we've had a bunch of them on. I really like them. They've changed their ways, and you should be willing to own some of the newly disciplined oil producers. So I'm going to go through my favorites. Many of them we have had on because you have been asking me, saying, Jim, give me the best. Simply the best. Tina. First, you've got the variable dividend plays, and that starts with Devon Energy, DVM. Now, this one came back on my radar when I realized that Devon was the best energy performer during the first half of the year, largely because they were the first producer to implement a variable dividend plan where they gave their investors a cut of the profits rather than just a set payout. Hey, by the way, that's a big reason why this stock won't quit. You know, it's the best performer in today's session in the entire S&P 500. It has led the S&P 500 probably more than any stock I know this year in each individual day. You know why that is? Because this Devon is the brainchild of one of the smartest people I have ever had the pleasure of riding a helicopter with. And that, by the way, that is not a low bar. I've ridden a lot of helicopters. This is the brainchild of CEO Rick Muncrief, okay? I want you to remember that name. He took over as CEO in January after the company merged with WPX Energy. When we last, remember, that was smaller, and yet he got to run the company. We last spoke with him in August. And Rick, you're invited back on right now because that's how smart you are. And he explained that the company has a whole new mindset. Rather than borrowing money to drill like crazy when business is booming, he wants to reward shareholders. The stock's giving you a quick 31% gain since that interview, including a terrific 7.75% move today. Even after this run, I like it up here because based on the way they calculate the variable dividend, it works out to be one of the best yields in the S&P 500. Hey, how about this one? Longtime Cramer fave Pioneer Nat. That's what we call it, but it's Pioneer Natural Resources. It jumped on the variable dividend train in February, about a week after Devon, with a plan to distribute up to 75% of its free cash flow to shareholders. We didn't expect this to start until next year, but last month they moved up the timetable and started paying it almost immediately. Based on what they paid last quarter, the stock's got a 5.2% yield, although it should be higher than that based on the company's cash flow estimates for the next 5 years. Plus, Pioneer's got some great assets in the Permian Basin that are worth a lot more as long as the industry remains disciplined about production. Management like at Devon is fantastic. Scott Sheffield, the CEO, is one of the brightest lights out there, cares about the environment. Number 3, Diamondback Energy. This company used to be one of the most aggressive drillers out there. Yet last Thursday, they told us they're going to return 50% of their free cash flow to you, the shareholders, starting the fourth quarter, either in the form of buybacks or variable dividend. For the moment, Diamondback prefers buybacks. They just announced a $2 billion repurchase program because they think the stock is way too cheap. But once it goes high enough, management says they'll roll out a variable dividend instead. Since then, this thing's been on fire. It's got more room to run. Wow. What if these independent exploration production outfits are too risky for you? And I get that. Let's say you want a stable dividend that's actually out of cash. You know what? Then you've got Chevron. That remains my favorite. Even when I hated the oil complex, I still like Chevron. It's just that well run. Always has been. Not only are these guys disciplined about production, they've also gotten religion on climate change, spending $10 billion up from $3 billion to find ways to cut carbon emissions. Last week, Chevron held its energy transition event where they laid out all of this in great detail. It was fantastic. Carbon capture, hydrogen power, they really like that. Sustainable aviation fuel, renewable natural gas from methane. We spoke to CEO Mike Wirth last week, and he told a terrific story about investing in earlier stage energy technologies that could potentially produce big returns. I think that's a better use of the money than renting more oil rigs. Plus, in the meantime, Chevron's paying you to wait with its bountiful and safe 5.4% yield.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.